Most people shop for insurance based on price, but that could be a costly mistake. In this episode, we talk with longtime instructor Rodney Schultz about what people get wrong about coverage, why it matters more than you think, and how one simple oversight could impact your financial future. Please enjoy. Welcome to Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services in Eastland, Texas. Tune in every week as we share important information to help you and your family live life on purpose. Insurance, investments, legacy and tax planning, and much more. All covered now on Life Planning 101.
Well, welcome everybody. We have a special guest today. It's Rodney Schultz. I've known Rod probably for somewhere around 30 years. And I met him through a professional organization that we both have belonged to, the National Association of Insurance and Financial Advisors. Used to be the National Association of Life Underwriters back when we had met each other. And he served in many leadership roles, including the president of the state of Wisconsin. But one thing he is a teacher, and he has taught and written instruction books for insurance licensing in Wisconsin as his main source of livelihood. And he's doing that right up till this day. And what I thought would be interesting is the fact that he's had all this experience teaching students and some of the maybe myths or misconceptions that these students might have, and helping to get them in the framework of they're not selling policies, but they're solving people's issues or risk or problems, and making that something that's not transactional, but more as a consultant or counselor. And he does a fantastic job. He's taught many people in my office, including my own daughter, who recently got her insurance licenses just within the last year or two. So, Rod, thank you for joining us.
Thank you, Jim.
So, why don't we just start out with what got you into the teaching aspect of the insurance industry?
Well, I took a course that was similar to what I teach now, and the instructor was traveling all over the state, and I just like to educate people, so I went back, got my degree in education, and wrote the textbooks, and been doing it for probably 42, 43 years now. I'm starting to lose track. But I just love teaching because it's an opportunity to make people understand exactly what we do.
And what would you say is your favorite part of teaching?
Interacting with the students, and the students that catch on, that are really interested, that appreciate having the classes. Later on, they come back and say, I had your class 15, 20 years ago. It was the best class I ever had. I just read recently, I was looking back at some notes, and someone said you were the best instructor I had. I went to University of Minnesota, and you were the best instructor I ever had. So I guess a pat on the back's nice, but knowing that they're understanding the information that I present to help them in their profession.
Now, I know that, with my experience, when you were teaching my daughter one of the classes, and, since COVID, the world has really changed. A lot of stuff is being done online. And my experience has been when taking an online course, it can be quite challenging to stay engaged in that class. Not to mention that a lot of times I look at these classes or reading out of a textbook, but I was really impressed with how you engaged your students. Comment a little bit about your philosophy with that.
Well, some schools, they can't see the students, and the students can't communicate with them. When I was teaching for the technical colleges, I'd be teaching at 4 different campuses. I'd be teaching out of New Richmond, but I'd be also on the campus for Superior, Ashland, and Rice Lake. So I'd be teaching at 4 campuses one time. It's kind of like the before Zoom. It was where I had the whole classroom. But what I like about Zoom is, first of all, the students, if they're in a pinch, they don't have to travel all over the state to get to a class. It saves a lot on expenses. I have total control in terms of they have to be on camera. They have to be able to communicate with me. I love interacting with them. I can answer their questions right away. And it's just a really good experience that I didn't think Zoom was going to be a good answer, but it turned out to be the best answer at this point.
So I know that that's changed the world and but it hasn't changed the subject matter that you're teaching. It just creates maybe some additional challenges, but also those opportunities, like you said, without having to travel, making it more efficient, easier to attend.
I had one woman bail out of class, and I said, "What happened?" She said, "My dog threw up." Well, you never have that kind of situation when you're in a strict classroom. So,
Yeah. Well, and I know being in Wisconsin, sometimes if you're having a class in January, it might not be the easiest to get to and from the class. But
absolutely.
but at any rate, so now the reason I had you on here, if you're the teacher's teacher, I look at when we get to insurance, it's probably one of the most misunderstood areas of people's planning. And a lot of times, especially when it comes to like auto and homeowners and umbrella coverages and things like that, people's eyes kind of glaze over. And it seems like the industry as a whole, it's all about price. We can save you this much, just switch to us. And it seems to be very price sensitive, yet we're in a time right now where prices have increased dramatically with increased repair costs, building costs, lawsuits, all that stuff has made it much more expensive than it was just a few years ago. But talk a little bit about that. Is it a price thing, or are people maybe looking at it a little bit wrong?
Well, I think people are looking at it a little bit wrong. The sad part is when 800 numbers came into being, people were saying, I saved so much money by going on this 800 number or going online. And what they don't realize is that they're undercutting them on the coverages completely. I called the company one time, just recently, I called like 3 or 4 of these 800 numbers to find out what they were doing. No, I've got coverage of 250,000, 500,000, and 100,000. And, they must be able to see what I have for coverage because that's what they quoted me right away. But then they had me down for the state minimums of uninsured motorists of 25,000 per person, 50,000 per accident. Now, uninsured motorist is when somebody hits you and they don't have insurance, and my bodily injury is going to be covered under my uninsured motorist coverage. And I have 250, 500,000. So that's one way that they reduce the premium. Then they had me down as declining underinsured motorist. Well, I have 250, 500,000 for underinsured. That's where somebody underinsured has coverage, but they have insurance coverage, but they don't have enough. And my bodily injury is going to be covered under my underinsured motorist coverage. And then they had me declining underinsured motorist. So what they did is they dropped it off. And I says, what about underinsured? And he says, well, I'm sorry, but we don't have you. I put you down as declined. And then they put me down as for medical payments. Medical payments typically is around $10,000. And if somebody in your car gets hurt, then what they do is they're going to pay for your medical expenses up to the limit, which really isn't a lot. But sometimes with people today have a $15,000, $10,000 deductible, it takes up a lot of that space. So what they're doing is they're leaving off coverages, and then they're shorting them on the required coverages. And unfortunately, what happens is people, if they ever got in a serious accident and they're liable, they're going to be broke for the rest of their life. I was just talking to a guy in class, and he said that he knew someone in their 20s that is now 53, and they're still paying off on the losses that they had when they had a serious accident. Can you imagine how unfortunate that was by not having the proper coverage?
And don't you think most younger people, and they get the advice, well, you got nothing to lose, you don't have any assets, but they have all their future earnings ahead of them. And I think a lot of times younger folks, and I understand the premiums are high, they're trying to balance things out, but they've got a lot to lose, just like someone who's approaching retirement and has a life savings to lose.
And that's correct. And you can say that younger people, mid-age and older people, they say they don't have the money. And if you know exactly where every penny goes, then I can certainly understand. But I was teaching a class one time, and before class, I saw a woman drinking one of those iced coffee drinks that you get at the gas station. And I said, how much are those a piece? And she said, I think like $3.69 a bottle. I said, how many drink a day? 2 to 3. I figured she was spending $2,000 a year just on those iced coffee drinks. And I had another woman said that she's broke. She got 5 kids. She's had a lot of financial problems, and yet she gets $6.50 cappuccinos at one of the coffee shops twice a day. That's $12 a day. For that kind of money, now I'm not saying cut out, but they could certainly cut back and have the money to be able to afford it. And if they went out and got competitive quotes, they would find out that it might be more affordable than they think. Just like life insurance, Jim, you sell life insurance. And when I heard you speak recently, you said that for the cost of insurance today, it's very worthwhile to make sure that you have the proper coverage.
Now, let's talk a little bit about umbrella coverage because, most people don't even understand what it is. Now, I do see, it seems like more recently that it's being talked about a little bit more. Maybe the companies are pushing a little bit harder. But I know when I first got into this business and, we offered as kind of an accommodation because as a certified financial planner and someone that does works as a fiduciary, we look at everything. We look at their investments. We look at their insurances. And for many years, I didn't offer this type of insurance, but I was getting frustrated because here I'm building this wonderful plan for my clients, but they're one lawsuit away from losing a good chunk of it. And a lot of them didn't have umbrella coverage. And umbrella is liability that expands your liability coverage over all your underlying coverages. So, for example, if you have a boat or a motorcycle or an ATV, your house, your other toys that you have, Rod was talking about 250, 500 on limits. Well, this might put an additional $1 million or $2 million or $5 million over and above your underlying limits. And the insurance, at least in my experience, has been, now it's maybe a little bit more than it had been, but I find that a lot of cases, it's about $150 a year for the first million, and then maybe $125 a year for each million after. And I look at that as very inexpensive because if you have $3, $4, $5 million worth of coverage, you're paying less than $1,000 a year for that. And it seems very inexpensive. Well, the reason it's very inexpensive is the frequency of those claims is few and far between, but all we have to do is flip on the TV and we'll see 100 law firms bragging about the billions of dollars they've collected in lawsuits. So it's not that it doesn't happen, but when it does, you want to make sure you're properly covered. Talk a little bit about umbrella coverage.
Okay. You did a pretty good job, Jim. But let's say, that person that, we know somebody recently that someone ran a red light or ran a stop sign and just T-boned this individual, and they're really, really hurt damage-wise. If someone has limits of, just think of the hospital bills, they're going to be well over probably $500,000. And if somebody has a policy with 25,000 per person, 50,000 and 10 like the state minimums, first of all, they're not going to have enough coverage. And an umbrella policy gives you an extra layer of coverage. Now, just so you know that an umbrella policy, you're going to have at least a minimum of 100, 300, 100 for liability limits. Most companies have a minimum of 250, 500, 100 for a minimum before you can buy an umbrella policy. And you're right, the frequency of something like that happening is pretty slim. But you must remember that in Wisconsin, if you kill somebody in a car accident, wrongful death, you have to pay out immediately $350,000. for an adult, and then if it's a child, it's 500,000. So if I have 250, 500, well, if I kill an adult, they're only going to pay 250 of that 350. And it's not only that, but they can go for health-related expenses if I'm not killed, lost income and benefits, property damage, pain and suffering. They can go back for future loss of earnings. They can go for medical treatments, diminished earning capacity, ambulance, emergency, doctor bills, hospital bills, lost wages is a big one. And then, of course, the property damage to the vehicle that you hit, or if you hit somebody's house, which would also cover. So what that umbrella policy is, in the case that I gave, if you killed an adult and you have 250,000 that's going to be paid from your underlying limit, then that extra 100,000 is going to come out of the umbrella. So what it is, it's like added protection they use in emergencies. But you got to remember that an umbrella policy is not only for auto. When you buy an umbrella policy, it gives you an extra $1 million or more for homeowners or renters also. And I've got a $3 million umbrella policy, and right now I pay about $40 a month. $40 a month for $3 million of coverage extra, to me, is really important. And when I called to get a quote online, what they do is they send you to a different person for umbrella policies, and the premium for a $3 million umbrella from one of these 800 numbers per year was $1,490. My premium is $475 a year. So if you want to get the better coverages, you're not going to be saving money, because all the quotes that I got, they didn't save money at all. But that umbrella policy to me is one of the most undersold policies out there. And if it's not explained correctly, a lot of people don't understand it. So why should I pay $150 extra a year because of that? And the other thing you got to remember is if you got your auto, home, renters, whatever, and you get the umbrella, you get a multi-policy discount typically of 10%. So it might even cost you less.
Well, one thing I'm a big believer in is annual policy reviews. And we offer it at our agency. And it's amazing. You almost have to beg people to come in just to do those reviews. So I would imagine without even offering an annual review, because I know most places, they won't even offer you an annual review. And what amazes me is how many people don't even understand what coverages they have, and they'll quote it. And because they're saving $10 a month, they'll switch. And they may not realize that that $10 a month might have been the umbrella policy that gave them an extra $1 million of coverage. That $10 a month probably isn't going to change their life a whole heck of a lot. But if they get a judgment against them for $1 million, that definitely is a life game changer. Now, one thing, when I was listening to you, Rod, when you were teaching my daughter, I happened to catch part of your class, and you had an interesting perspective about how lawsuits, and how that can be a way of maybe helping determine if people have proper life insurance. Tell the story that you share with your class.
Well, there's two things I want to share, Jim. And the first one is sometimes people don't have much in assets, like you're saying. And they say, well, why should I take out a lot of insurance when all they're going to do is take nothing because I don't have anything? But you talked about the long range aspect of them garnishing your wages. But I had a agent tell me that a policyholder of theirs got killed. And the widow, it was a pure accident, wasn't drunk driving or anything, pure accident. And the widow of the person that killed, the widow wrote a letter to the person that killed her husband and said, I understand that this was an accident, but I just want to thank you for having the proper amount of coverage, because I don't know how myself and the kids would have got by if you didn't. And Jim, many families today are two-income families just getting by. And all of a sudden, if you took out one of the breadwinners, all of a sudden, how are they going to pay their bills? How are they going to pay their mortgage? How are they going to raise the kids? Childcare issues. There's so many things that are affected when somebody doesn't have the proper coverage. And it's a pretty selfish attitude when somebody says, well, let them take what I don't have. But what are you going to do to that person that you hit? And that's one of the examples that really struck home. And you got to remember how you're going to affect the people that you accidentally killed them, or because you were just not paying attention.
That's I tell you, Rod, I never even put it in that perspective, but just the human element of taking care of your fellow man, especially if you are part of the reason that a family got hurt, that's pretty awesome.
Yeah, and the other example is, let's say someone's age 35 and they're going to work till age 65, and that's 30 years, correct?
Yep.
If they're making 50,000 a year and they got killed at age 35, how much lost income is that?
Several million.
1.5 million, yeah.
Yeah.
So that's, as you know, in life insurance, we talk about human life value. What was the potential income? Now, that's not including pay increases. That's not including inflation. But let's just say 1.5 million that they could sue for. And when I ask my classes, I say, well, I go around and a lot of them have spouses, significant other, partners, whatever. And I say, well, how much would you ask the court for if your spouse is driving down the highway, somebody crosses the center line, they fall asleep, they kill your spouse? How much you can ask the court for? And what do you think they say, Jim?
$1.5 million if it's 50,000 a year for the next several years.
Yeah, but in their situation, it's usually $1 million, $2 million, $5 million. They're all over the place in terms of what they ask them. So then I follow up with the question, let's say that your spouse, significant other, partner is driving on the highway and they fall asleep at the wheel and they go off, they hit a tree, they're dead. How much life insurance do you have on them? And their mouths typically drop right open because they say, well, 50, 150, and I don't have any life insurance on them, or I don't have any life insurance on myself. And I asked them, well, what's the difference? Does the need go down if somebody else kills them versus them dying by their own hand? And it really brings home the need for why you got to have life insurance, because now all of a sudden they realize that, yeah, how am I going to pay my bills if I don't? And that's, I think, what you're talking about, Jim.
Oh, yeah. And one of the things, I mean, just before we're having this meeting, I was talking to someone and she's asking me, yeah, we're thinking about looking at our life insurance. What are your thoughts? Can you send me a quote? I said, well, I can send you tons of quotes. They might not mean anything. We need to actually sit down and get together and figure out how much you need. And there's a lot of factors that go into that, and every proposal we customize. So I said to her, now, if you're sitting down, I'll tell you where our starting point is. And being a financial planner, there's a thing called the 4% rule, and that is the rule of thumb of what the safe withdrawal rate is under any market circumstances, all the different variations we've had through the years. If you have an optimal blend between stocks and bonds, which is about 60-40, and if you retired at 65, you could withdraw 4% adjusted for inflation and not run out of money as long as you agreed to die at life expectancy. So a lot of times there's, and as you can tell from my description there are some holes in that, but now we've seen a lot of them that say even 2 and 3% is a safe withdrawal rate. But with that said, I figure 4% is a good starting point. And I do believe as a financial planner that we can do things other than just stocks and bonds to be able to have a sustainable 4% withdrawal rate. But if you look at that, if someone's making 100,000, if I do 25 times their income, that's 2.5 million. 4% of that's 100,000. But what are we forgetting? We're forgetting about, oh yeah, we got the health insurance through my spouse, and that's 800 a month, and they're putting a 6% match into the 401k, and that's another $6,000, another 500 a month. So is even that enough? Now, yes, we are going to maybe have some expenses lower. The grocery bill might go down, but it might go up if we have a single parent household and they're working full time to try to pay the bills, trying to get the dinners made might start to become a strain. So there's a lot of issues that are factors in determining the amount of coverage, and then what type should you get. I see a lot of people with permanent life insurance where they're building cash values, and I'm a big fan of that, but not at the expense of being improperly covered. If you have a younger person that's in good health, they could get a couple $1 million of coverage, and it might be under $100 a month. If they do a permanent policy where they're accumulating cash value, they might be contributing $2,000 a month. Well, one might not be a good fit depending on what your goals and objectives are, what your cash flow is, what your priorities are. There's a lot of things that go into having the proper coverage. And it's interesting because I don't know too many people that make the analogy between how much life insurance someone should have, versus what would you sue somebody for, or what could you be vulnerable for if you were the one getting sued. With inflation and everything else, people should be looking at that. So let me ask you another question, Rod. I know we've had high inflation, and I know that we are hearing a lot of people complaining about their insurance costs for homeowners and auto. It seems like they've been going up at a faster rate than I can ever remember. Do you have some rationale behind why that's happening, or is it just insurance companies deciding they need more profit now?
I think they need to drive better cars. No. Well, that's really, you talk to anybody that's an insurance agent or a sales associate for an agent, like a customer service rep, all day they're getting complaints, people calling in and saying, my insurance just went up 35%. My insurance went up 45%. And the reason why is because insurance companies are losing money. I was talking to a major company, and they said that they lose $1.04 for every dollar that they take in. So that means that they're losing money. And if it wasn't for their investments, they would be they'd be going broke. I mean, I was looking at a article today that in 22 and 23, one of the large companies out in California paid out $6 billion per year in losses. These wildfires are causing a lot of problems. The windstorm damage, the tornadoes are causing damage. And what people have to remember is insurance is a shared risk. Because I talked to one person, she said her parents' home burned to the ground. It's a $1.2 million loss. Well, the parents paid nowhere near $1.2 million. So you have to realize that when there's a major loss like that, as well as anywhere, all the policyholders have to chip in to help take care of that cost. Because a lot of people say, well, I've never had any losses for the 25 years I've had the policy. But the problem is other people have. And that's what drives up the premiums. Now, the second thing you have to realize is when COVID hit, I mean, look at all of a sudden the cost for materials, plumbing supplies, heating, electrical, sheetrock, all those went sky high. I mean, you could not buy sheetrock for the price that you did back in the day when you do a lot of construction, Jim, so you would know what that's like. But then you take a look at labor costs. Labor costs, there's such a shortage in labor that labor costs have gone sky high. Then you take a look at all these electric cars. You take a look at all the electronics in vehicles and what it costs to get these fixed these days. It all increases the cost of a claim. And when insurance companies see all these losses, they have to raise their rates. One major company said that they're asking for a 35% homeowners rate in California today. And people are going to go nuts. And I can understand why they would go nuts, because I don't like to pay increased premiums either. But the problem that we have to realize is that it's a shared risk. And you may not have had any losses, but you still have to help pay for the losses for the people that have.
Well, I got two personal stories to deal with that. I used to have a Volkswagen Touareg, and I think it was a 2012. And a couple years ago, I was driving and I hit a deer. And all it did was smash the front passenger side headlight. and the insurance company was totaling it as a loss. And the vehicle, I had bought it for used for like 17 grand, and they were going to do a total loss. I had driven it for 50,000 miles and had it for a few years, and they were telling me they were going to value it at like, 15,000, and they were just going to total it out. It was drivable, everything was good. The only thing is I needed to get the headlight fixed. So they gave me an offer to buy the car from me, or give me the claim number for the total value of the car minus my deductible, or they said I could take 3 grand less and keep the car. And I thought, for 3 grand less, I'm not too proud. I don't need to get all the paint fixed up and everything else. It was just a good driver, but I needed to make it legal and have that headlight fixed. And the auto shop said they could probably do it for $1,600. And after a couple of weeks, I'm calling them, what's taking you so long? And they said, well, this is going to be much more major than we anticipated. And they talked about how in the day, not so long ago, they could be profitable at $50 an hour. But now to hire technicians to fix it, they're at like $150 an hour labor cost. And they said there's no way we can get it done for $1,600. So I end up getting the rest of the money from the insurance company. The other thing I look at is we had a project at home. We were building a deck, and we had composite decking that we were looking at. And, with winter coming on, we didn't quite get it done. And I thought, well, I'm not going to buy the decking material till next spring. But the decking material was $37 a board. And I was looking at, these were 16-foot composite deck boards. And I'm like, well, I'll just wait till next spring. Next spring came, and they were $137 a board. So then I delayed the project a little bit longer. I finally got them for $90 a board, like a year later. I delayed my project for a year, but and they did come down a little bit. But as you mentioned, during COVID, we had supply chain problems, and we had a lot of factories that were slowed down or shut down, and we end up having shortages, and all that contributes, to when you have a claim, it costs more to fix it. So like you're talking about their house burned down, 1.2 million. If they built that thing 10 years ago, it might have cost 400,000 to build it. But 2x4s have gone from a couple bucks not so many years ago to now it's $10, $12 in some parts of the country. So the costs have just skyrocketed, we're seeing it now when we pay our premiums.
Yeah, one thing that you mentioned, your annual review, just think if a homeowner hasn't had their homeowners reviewed in 5, 10, 15 years. They might have been adequately insured when they took out the policy, but now due to inflation, building labor costs going up, they might be underinsured. And that's the problem that people are going to run into. That's why that annual review, I know a lot of companies for auto and home, they request an annual review every year to make sure that it does not fall through the cracks. But the problem is some agents they got so many customers, they can't contact them.
I look at replacement cost coverage. I know a lot of people, well, how much more is that? No, I'm not going to go with that. And if they did that 5 or 10 years ago and they have a loss now, boy, they might be lucky to get 50 cents on the dollar back.
Yeah, and that's why companies with computers, they can pretty well pinpoint how much it's going to cost at today's cost to replace your home. Plus, a lot of homeowners policies, you can pay an extra premium and have 120 or 125% coverage of the insured value. So you got a little bit of a buffer.
And I know I've heard the response from people, oh, it's just the insurance company's trying to jack up my rates. And it's interesting because I'll see people say, well, my house isn't worth that much. And they'll argue with the agent, and then they'll say, well, no, put me down for 400,000, not the 500,000 I was calculated, not realizing that when they have a loss, they're going to have a lot of money out of pocket.
That's right. Or, when somebody says something like that, you would ask them, well, what room would you not replace? And they go, what? What room would you not replace? Would be a bedroom? Would you downsize the kitchen? Would you eliminate an office? You're going to have to leave. Well, I don't want to do any of that. Then you're not going to be able to insure it for the amount that you want and have it replaced if something happened.
I just heard recently twice people that had a problem in their kitchens, and one of them they had remodeled their kitchen, and the people that installed the new dishwasher forgot to connect it, the drain,
Hmm.
right? So it didn't drain enough that they would notice after washing the dishes each time, but they started to notice when all of a sudden mold had taken over their kitchen. And it cost them over $150,000 in repairs, not to mention while the repairs were being done and the mold abatement was being done, they had to live in hotels for a while they did the fixing. And fortunately, they had good insurance that took care of it all, and I hear some people when you talk about that and they said, well, you just, the contractor should have to pay for it. Well, look how many contractors went under during COVID, and you might be able to get the contractor to pay it, but if they don't have adequate insurance, you can get a charging order against them maybe, but what is going to be your ability to pay if they're not in business or don't have enough resources to pay it? Or God forbid you use someone who's moonlighting on the side and they're not bonded, they're not insured, and something like that happens. And it's not like they did it intentionally. No, no, it's just we're human, and a little error like that can cost so much money.
Yeah, and I agree with that. And a lot of people are penny wise and pound foolish. And you're right, they think the agents are trying to oversell them. But then you look at some of these 800 numbers are underselling them and doing a great disservice to people because in the end, if something happens, it's going to cost them financially. So the problem that people have is they don't trust agents and they should. And like any consumer product, if you are going to, if I want to insure my auto and home and I'm new, I would go interview like 3 or 4 different agents and see what they recommend and find out which one, first of all, I'm comfortable with. And second of all, premium shouldn't be the main factor. I know for many people it is because people want to save money, but I've heard a lot of people that say these 800 numbers, they're on the phone for hours trying to get their claim settled, and it's causing a lot of problems. And I'd rather pay a little bit more money and have a great agent and coverage than save a little money, and then if something happened, I'm going to have problems.
Well, Rod, I always had the saying as your insurance is as good as your agent. If you got someone on your side that's going to back you up at claim time, help you understand the processes, prepare you before a claim of what to expect, you are going to be light years ahead. The other thing I always tell people too is pass on to the insurance company the stuff you can't afford to write out a check for. So things like umbrella might be really important, but then maybe instead of having a 250 deductible on your collision, maybe you go with 2,500. You can afford the 2,500, but you may not be able to afford the multi-million-dollar lawsuit. So make sure that the risk you can't handle, you're shifting that to insurance company. And that's a way that you can save on premiums by not having all the little stuff covered. And while it's convenient to have some of that little stuff covered, it's maybe not necessary from a financial security standpoint. Any final thoughts, Rod?
Well, when you're talking about that, you got to realize that a lot of people might have, I have a class of 20 people, maybe 2 or 3 people have had a serious claim. So why not go up to a higher deductible? And you as a financial planner know what they should do is take that difference in premium and set up their own deductible account for auto and home so that when something would happen, then they have a deductible account that would take care of it. But I wanted also to mention that there's also a misconception that insurance companies don't want to pay claims. And I will ask my classes how many people have had claims at some point, and number of people raise their hand, and I'll say how many were not settled fairly, raise your hands, and maybe 1, 2 people. So when people say insurance companies don't want to pay claims, they do. They want to make sure everything's going to be taken care of in a timely fashion to make sure their customers are happy.
Well, Rod, I appreciate you joining us. You're a wealth full of knowledge, and I appreciate the common sense, practical way you look at things. And hopefully, for the people listening out there, if you have not had a review or talked to your agent in more than a year, you might want to sit down and talk to them, especially now where rates have been changing very quickly, We've seen insurance companies even pull out of certain states where they can't afford to make it go. And so you want to take a look at that. It's not a bad idea. One thing we find during those annual reviews, sometimes people are paying for insurance they don't need anymore. For example, the kid that was living in their house went to college and now has moved on, and they're still paying for this kid who's out of their household, doesn't drive any of their cars, or they buy a new snowmobile trailer or sell one, whatever the case may be. Our life is changing on a daily basis, and yet we're not looking at our insurance on a regular basis to make sure it's current, and we're not paying too much, but as Rod talked about today, maybe not paying too little as well. So thanks again, Rod, and look forward to having you on again soon.
All right, always enjoyed talking with you, Jim.
Thank you for joining us for Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services. If you have questions, you can email them to lifeplanning@kennedy-financial.com. Be sure to tune in next week for more Life Planning 101. The opinions expressed herein are those of the firm and are subject to change without notice. The opinions referenced are as of the date of publication and are subject to change due to changes in the market or economic conditions and may not necessarily come to pass. Any opinions, projections, or forward-looking statements expressed herein are solely those of the author, may differ from the views or opinions expressed by other areas of the firm, and are only for general informational purposes as of the date indicated. Securities offered through Calton & Associates Incorporated, a registered investment advisor, member FINRA SIPC. Investment advisory services offered through Smart Money Group LLC. Kennedy Financial Services and Smart Money Group LLC are separate entities and are not owned or controlled by Calton & Associates Incorporated.